Well folks, here we are again, with the economic circus taking another turn, the latest CPI data showing that December's numbers are lower than forecast, but don't get too excited just yet. Let me walk you through what this means, and more importantly, what the Fed, Wall Street, and the government are trying not to tell you. The U.S. economy saw some signs of cooling inflation in December, with the Core Consumer Price Index, CPI, rising only 0.2%, down from the 0.3% increase witnessed for the last 4 months. On the surface, this feels like a relief, like the country may finally be seeing some progress in the battle against rising prices. Energy costs, especially, account for a large portion of this slowdown, as indicated by the headline CPI jump of 0.4%, with over 40% of that being energy-related. But let's not celebrate prematurely. Sure, cheaper hotel stays and smaller increases in rent and medical care services contributed to this so-called deceleration. But the Federal Reserve isn't looking to crack the champagne open just yet. Why? Because inflation progress isn't about one good month out of 12. The hard truth is the Fed wants to see a consistent downtrend, and believe me, one swallow does not make a summer. What's so magical about the core inflation, excluding food and energy? Because these volatile categories distort the broader picture, and when you remove them, we're left with a much clearer, underlying view of inflation. And here's the kicker, consumers might feel the pinch even more in areas like housing, healthcare, air travel, and everything else they need to survive. Even though last week we got hit with a surprisingly strong jobs report, which by the way, suggests the economy's not cooling off as quickly as some might hope, there's now this renewed talk about the Fed potentially cutting interest rates sooner rather than later. Some so-called experts are floating the idea that March could see the Fed ease rates after nearly a year of aggressive hikes. The market's already dialing back its expectations, hoping for looser monetary policy to keep stocks soaring. Treasury yields fell and the S&P 500 saw a resurgence after the report, with the US dollar losing steam. But let's not kid ourselves, folks. Just because inflation is slightly subdued, doesn't bulldoze away the hard-earned lessons of the past year. The Fed has been spooked by persistent price pressures for a reason. The bond market suffered its worst sell-off in decades, fueled by the Fed's rapid rate hikes. And those policymakers? You better believe they're not just waiting to pivot because of one good CPI report. They know better. And they're wary of making the same mistakes we saw back in the 70s when the Fed eased too quickly, inflation spiraled out of control, and the country wound up in an extended recession. You might ask, why won't the Fed just ease up? Well, Jay Powell and his fellow central bankers want to remind us about one word, credibility. They've been painting inflation as the economy's biggest enemy, one that's already cost the public a lot over the past couple of years, from eroding wage gains to driving up the cost of everything from grocery store staples to rent. If they backtrack now, they could find themselves overcorrecting, leading us back into the inflation trap later in the year. Here's what's really at play, wage growth. Now that inflation is starting to slow, however temporary, everyone assumes that hourly earnings will soon rise in tandem. But guess what? They haven't. Real hourly earnings barely grew by 1% year over year according to the latest report, compared to inflation's 3.5% peaks over the year 2023. This creates a fundamental problem for the federal wage growth needs to pick up to drive disposable income and consumption. But if wages increase too quickly, that same wage pressure will stoke inflation again. It's an unsustainable feedback loop. This delicate balance between inflation and wage growth is where Fed policy decisions get really dangerous. A cooling labor market could make the Fed redo its timeline for rate cuts. And if businesses start laying off workers in droves, well, consumer spending will plummet, and we could see a recession become the story of 2025. Wage inflation is driven largely by the imbalance in supply versus demand for workers. There are still more job openings than job seekers. And that means businesses must pay more to attract talent. The Fed is walking that tightrope, trying to guide the economy to a so-called soft landing, but historically, those soft landings tend to turn into full-scale crashes. Let's pull back the curtain here. While the US grapples with this inflation mess domestically, there's also the bigger global picture to consider. The bond market's deep sell-off throughout 2024 wasn't just a US phenomenon. International markets felt it too, weakened by not just inflation but the fallout from geopolitical tensions, rising debt burdens, and shaky trade policies. Consider for a moment that the US's national debt hit a staggering $33 trillion in 2024. That's a number that nobody seems to like talking about directly. And these market pressures, combined with limited Federal Reserve maneuvers, mean that handling domestic inflation goes hand in hand with enormous international risks. Remember, many U.S. bondholders exist outside the country, particularly in places like Japan, China, and Europe. As debt servicing costs rise, aka higher interest rates, those investors get nervous. And when they lose trust, bond prices crater, rates soar, and average Americans get stuck footing the bill. Let us not forget the oil wildcard laid out by OPEC+. Energy was yet again 40% of the overall inflation gains in December. With the US so highly reliant on external oil suppliers, any tightness in the supply, say, due to geopolitical jolts, translates almost overnight into higher gas prices. This brings us back to an all-too-familiar vicious cycle: rising costs for American businesses, higher transportation expenses, juiced-up costs at the pump, and ultimately, more inflation further down the line. Looking forward, there's more turbulence on the horizon. With President Trump set to be inaugurated in just a few days, economists are already cautioning about a new wave of economic policies that could further complicate the inflation equation. It isn't a secret that Trump plans to bring renewed tariffs and protectionist measures into play. You don't need a crystal ball to predict what that means for consumer prices. Tariffs raise the cost of imported goods, especially from China, forcing American businesses to pass these costs directly on to consumers. And those tariffs could be driving up costs just as we're finally seeing some inflation relief. Plus, if Trump's policies start to mess with global supply chains again, well, we could be back to the days of waiting 6 months to get our hands on basic electronics, cars, you name it, all at sky-high prices. Don't discount the impact of consumer expectations either. According to the University of Michigan's recent surveys, consumer inflation expectations are creeping up again, largely driven by the uncertainty of upcoming political and financial shifts. Now add tariffs to this volatile economic mix, and you're looking at a highly combustible cocktail. Here's what the financial talking heads don't always break down for you: while the Fed, Treasury yields, and CPI reports drive Wall Street traders bonkers, it's average Americans who bear the brunt in their day-to-day lives. Inflation erodes real income, making it harder for them to afford groceries, rent, medical bills, and all the other essentials. The irony here is that, while economists get excited discussing the latest inflation print or the Fed's next rate-changing move, most everyday folks are just trying to stretch their paycheck a little further. And yet, both groups are caught in this tug-of-war. When the external markets tank, bond yields spike, and inflation eats into purchasing power, it's Main Street that suffers the most. Policies crafted with high-minded objectives break down when they don't filter through to the hands of the average worker. We're in for an interesting year, folks. Inflation has backed off slightly, but there are pressure points everywhere, from wage growth struggles, to housing woes, to geopolitical tensions. And while consumer price indices might show a meager cooling trend, the true fight for balance in the US economy is far from over. If you think that one good CPI number means the coast is clear, think again. The real challenge lies ahead, where policy decisions will need to juggle a precarious combination of wage growth, corporate profits, tariff impacts, and global market interconnectivity. The Fed may cautiously ease rates, but this reliance on moderating inflation and boosting wages is a balancing act the economy may struggle to walk. So don't breathe a sigh of relief just yet. The inflation battle isn't over, it's just entering the next phase of this long, winding war. Shelter prices, although inching up more modestly at 0.3%, still remain a glaring spot for millions of working-class Americans who have seen rents and housing prices skyrocket throughout 2024. And, let's not forget that while CPI captures inflation, it doesn't always reflect the day-to-day reality of paying heating bills or soaring grocery prices. Inflation hasn't left the everyday consumer's life, folks, it's simply recalibrating.